Well, we got trade numbers out again in the U.S. today, and which I think is probably the biggest news coming out today for the long term. Short term, there's a lot of stuff going on, obviously, with some slight pause earlier today in the oil price decline, which is probably going to end. But we've got what I'm looking at right now is a picture of the US dollar index. So this is the dollar versus a basket of other currencies. And as you can see here, recently the dollar's been on this real run up to levels that it hasn't been in since the end of last year, first part of this year in 2008. And what I like about this, so I've applied little blue arrows here to describe or to identify the previous trade balance numbers. So were those numbers improving, little up arrow, or were they declining, little down arrow? And you'll notice that over the last 7 announcements, we've had 5 that were pretty positive. So 5 to 2, positive to negative. This is good, and this is something that economists would describe through the use of the J curve. So now, while and what the J curve more or less develops, and when you look at a price chart, is going to be this long-term appreciation following a depreciation in a currency's value. So you can see that forming a little J. Now that, by the way, is not where the J curve gets its name, but that is kind of what happens in the long term to an exchange rate, which is what we're seeing happen to the dollar. What happens is that because the dollar is getting relatively cheap, you get U.S. exports become much more attractive in denominated when exchanged for foreign currency. So that increases demand for U.S. exports, and you'll see U.S. exports begin to improve, or the balance of U.S. exports, the value of U.S. exports to the value of U.S. imports will begin to improve, and the deficit will grow less quickly, which is what we're seeing right now. So the deficit is still growing, but it's slowing that growth. So, and what happens is that as the market naturally progresses with that model, demand for U.S. goods continues to expand. That increases demand for the U.S. dollar, and then you get the U.S. dollar beginning to appreciate against other currencies. So we see this depreciation followed by appreciation as demand for cheaper goods basically goes up. So it's one of these things that we can use trade numbers to try to determine, well, what's likely to happen in the future. Now, this is a very long-term pattern, so it's something that happens not only over a matter of quarters, but even over years. But the real takeaway here is that although the U.S. dollar is at a resistance level, I'm just going to draw a line kind of bisecting that consolidation that we had that occurred. So we had this consolidation that occurred at the end of last year and into the beginning of this year. So if we draw a line right through the middle of that, or right through the apex of that consolidation, we're pretty much where we are right now. Now, the long-term macroeconomic forces here, there's a good chance that there is a lot more dollar appreciation in store. And that's one of the big takeaways, which means that if we break up above this level, or this consolidation level that we're at right now, so if we break up above the 77 mark or so, then we still have an opportunity here for dollar bulls to make some money. In fact, let's leave the dollar index, which is the dollar versus a basket of currencies, and go look at a specific currency pair itself. Now we can start by looking at the euro-US dollar, where we get this inverted J, and that's because, of course, the dollar is on the opposite side of this particular equation. The dollar index is the dollar versus, or slash, and then a whole basket of currencies. In this case, is the euro slash the dollar. So we have this inversion here, and the euro being a dominant currency in that basket in the dollar index itself. It's not a surprise to get this inversion. So, and speaking of which, we get this same, or this very similar looking consolidation from last year. So we are beginning to tread right through or approaching the middle of that consolidation. We're certainly approaching the top of that consolidation right now, or are at it rather. So this is a fairly critical inflection point, and both from a fundamental perspective, we have the potential for a lot more growth, and this may be the trigger from a technical perspective as well. If we break this support level technically, and we look at our fundamentals and we say, well, the trade numbers would predict, and remember, we're getting trade numbers that are lagging by a couple of months. The trade numbers would predict there's probably some outstanding demand for U.S. dollars, or that trend is likely to continue. We could see a lot more downside. Now, not only I think it's certainly applicable to the euro US dollar, but we may, from a fundamental perspective, we may even back up from this and say, well, this is likely to affect trade centered economies even more. So this shift in balance could really disrupt things like the commodity currencies or even the yen. In fact, we can back up here a little bit and we can look at the yen. Despite the fact that we've had a little bit of a pullback here, as traders are adjusting to the announcements from the banking sector and subprime, blah blah blah. We're getting this adjustment as traders squeeze the yen a little bit, and we get some strengthening there. But if we back up here a little bit, we put a line across the bottom of these consolidations, so once, twice, 3, 4, 5 times, and we finally broke up above that. We have some intermediate term support down here at around 107.50 or so, so about 200 pips away. There's whether we come all the way down here or to one of these shorter term levels of support across the top of these rallies that occurred in May or June and July at just over 108. Whether we come down to one of these levels and then bounce off, we can start to say, well, there's potential here, as described by some of the fundamentals at play, revealed by the trade announcement today. We can apply a Fibonacci analysis to the most recent decline, counter trend decline that occurred there at that resistance level. We've got an opportunity here. If we get down to this 108 level, so 120 pips down, before we get a little bounce, we could see another rally easily into the 111.50, even the 112 range here at the 161.8% retracement level. I think the takeaway here is that even if short-term forces such as those surrounding risk, and we're seeing that reflected in the equity markets, global equity markets, as well as the U.S. equity market today, although some of the short-term indicators would give us the impression that there is a consolidation in place on the U.S. dollar, which that seems to be reasonable. Looking out into the intermediate term, so over 6 weeks, 8 weeks, and beyond, it looks like we've got still some opportunity to the upside on the U.S. dollar, which is good for currency pairs such as long or positions such as long U.S. dollar yen positions, even short positions on like the Aussie dollar commodity currencies, long the dollar Canadian, etc. So those are some of the opportunities that I see beginning to emerge after we get a little bit of a consolidation here, which is what looks like we're probably going to get as traders just take a breather from the rally that we've seen occurring and adjust for a new or readjust for the risk discount that's out there. So, and we're seeing that play out a little bit already in the equity market. Long-term fundamentals, however, still indicate that there's some opportunity here on strong dollar positions.